So you want to try your hand at picking individual stocks, but the second you start looking into it, you just feel completely lost. Yeah, you're not alone. It can feel like a seriously overwhelming task. I mean, that's the million-dollar question, isn't it? With literally thousands of public companies out there, it feels like searching for a needle in a global haystack. But don't worry, there actually is a method to the madness. So let's dive into a framework that can help you make sense of it all. All right, first things first, before you even think about looking at a stock chart or reading some fancy analyst report, the whole journey actually starts with you. That's right, I'm serious. Smart investing has nothing to do with chasing hot tips or jumping on bandwagons. It's all about building a portfolio that's tailor-made to serve your personal financial goals. Everything, and I mean everything, has to flow from that purpose. So, what is your portfolio's game plan? Generally, it's going to fall into one of three buckets. Are you trying to generate a steady income, to maybe supplement your paycheck or for retirement? Or is your main goal just to preserve the wealth you've already worked hard to build? Or are you swinging for the fences and aiming for major growth? Your answer to that question is really what starts to define what kind of investor you are. And once you know that, it tells you exactly what kind of stocks you should be looking for. And this table here just lays it all out perfectly. If your goal is income, you probably don't want to take on a lot of risk, right? So you'll gravitate towards dividend stocks, companies that literally send you a check, like utility companies. If you're all about preservation, your risk tolerance is even lower. You're going to love those super stable blue chip companies. Think big household names that sell stuff we all need. But if you're chasing growth, well, you're signing up for higher risk, hoping for those much higher returns. Now listen, this is super important. You don't have to just pick one box and stay there. A smart investor always diversifies. Even the most aggressive growth chaser needs a few stable stocks to anchor the portfolio. And even a super conservative portfolio can benefit from a little sprinkle of growth. It's all about that balance. Okay, so you've done your soul searching, you know your why. Now we get to the fun part, finding the what. The best way to think about this is like a funnel. You start with the whole wide world of stocks and narrow it down and down and down to just a few specific choices. So this research funnel is basically a three-step process. First, you develop your big picture investment story. Then you find companies that actually fit that story. And finally, you do your homework and scrutinize the details to see if they're the real deal. And step one is actually pretty simple. It's just paying attention to the world around you. You're looking for big trends, big shifts. For example, maybe you notice there's a huge global push for renewable energy. That's your story. You form a thesis that companies in that space are probably set up for some serious growth. Okay, so on to step two. How do you actually find companies that fit your story? Well, you've got a few cool tools at your disposal. One great trick is to look inside an industry-specific ETF. Think of it as a pre-made basket of stocks all related to one theme, like our renewable energy idea. You can also use free online stock screeners to filter through thousands of stocks based on your criteria. And of course, read the financial news, but always, always with a skeptical, critical eye. For the final step, you gotta put on your detective hat and dig into the details. And here's a little pro tip for you. Start with a company's investor presentation. You can usually find it right on their website. It's designed to be a clear, high-level summary of what they do and where they're going, and it's way, way easier to understand than those super dense 100-page financial reports. So, you've got the framework. You know the process from start to finish. It all seems pretty logical, right? Well, hold on. We need to talk about the massive elephant in the room when it comes to picking stocks. Because here it is, the crucial reality check. And honestly, this might be the single most important thing you hear in this entire explainer. The hard truth is that most people who try to pick individual stocks, and yeah, I'm including the professionals here, they fail to do as well as the overall stock market. How many fail? We're talking more than 90%. No, that's not a typo. Over a 15-year stretch, over 90% of professional fund managers, people who do this for a living with entire teams and supercomputers, fail to beat the market average. Just let that sink in for a second. So you have to be asking yourself, why? What is going on? If the pros can't pull it off consistently, what makes it so mind-bogglingly difficult for everybody else? Well, a big part of the explanation is a theory called the efficient market hypothesis. It sounds complicated, but the idea is actually pretty simple. By the time you read some good news about a company, thousands of other traders have already seen it, and the price is already adjusted. The theory basically says that all the known information is already baked into the stock's price, which makes finding a secret bargain almost impossible. Now, I know what you're thinking, but what about Warren Buffett? And you're absolutely right. He's the famous exception that kind of proves the rule. He shows that beating the market is not impossible, it's just exceptionally, incredibly, unbelievably difficult. Okay, so we've got the how-to guide on one hand and this massive flashing warning sign on the other. So where does that leave you? How do you actually move forward and make a decision? Well, after you go through that whole research funnel, you might come out the other side with what you think is a golden ticket, one amazing stock, or maybe a short list of a few good ones. But there's a third possible outcome, and believe it or not, it might be the most valuable one of all. And that outcome is making the confident decision to not invest, to just walk away. Realizing that all your research just saved you from making a potentially bad investment, that's not a failure. That is a huge win. And that's really the secret sauce, isn't it? Successful investing isn't just about picking the winners. It's just as much about skillfully avoiding the losers. Knowing when to say no is one of the most powerful tools you have. So this all brings us to the final fundamental choice. On one side, you've got active picking, the whole detective process we just walked through. On the other side, you've got passive investing, which is basically saying, you know what, I'm just going to buy the whole haystack instead of looking for the needle. And as we've seen, that strategy often comes out on top. So now, the ball's in your court. You have the complete picture, you know the process, you see the potential, and you understand the monumental challenge. The decision isn't about being right or wrong, it's about being honest with yourself. Are you going to be the detective, digging for those hidden gems? Or the pragmatist, taking the simple, steady path? Or maybe you'll be a blend of both. Only you can answer that.